Welcome to Investomania, brother.
Let's take a look at small cap company Dave and Buster's. That's ticker symbol PLAY. Play. This $2 billion company is a dining experience like no other. It's a restaurant. It's a sports bar. It's an adult arcade. I mean, not that type of an adult. Not like an adult, just like a big kid. Okay, we're gonna move on. Does this business concept work? Does it have long-term growth prospects? Or is it a flash in the pan? You know, it'll work with a couple locations, but it's not really gonna work long-term. You can't really grow it. Dave & Buster's currently has 117 locations. Now, depending upon how lazy I am, I may or may not have a slide up which shows 115 locations. That was its last quarterly report. But they have opened 2 additional locations since. They currently only have locations in the United States, Canada, and Puerto Rico. Did I say that right? Puerto Rico. That's a good thing for growth investors, as it means, if things continue working, there's still all the international exposure. That's all still to come. We haven't really tapped in to that international exposure yet. So there's a lot of growth there. But there's still growth in the United States. Since 2011, Dave & Buster's has opened 63 stores. That's about doubling since that 2011 point, resulting in a compound annual growth rate of 12%. And it should be noted, these are all company-owned properties. Dave & Buster's has 24 signed leases as of their last quarter. 2 of those leases have already been opened. The current unopened signed leases alone represent a 19% location growth from the current numbers. So that's more or less already locked into place. I like that. I like that we already have 19% growth locked into place, already signed on the dotted line. Dave & Buster's sees the potential for between 231 to 251 locations in the United States and Canada. I'm not so confident about the upper end of that range, but overall I agree there are room for probably somewhere in the low, maybe mid, kind of like low mid, 200s of locations in the U.S. and Canada. So I more or less agree with kind of the range they're putting out. Investors need to understand this is not an Outback Steakhouse, right? You're not going to be seeing 500, 600, 700 plus domestic locations. However, with 117 current locations, that means you can still roughly double the number of location counts before you start running into issues like, okay, well, does it really make sense to continue building due to the nature of this type of business? It should be noted, however, that the remaining locations, I'm saying from this point on, going forward already, they're mostly going to be in smaller markets. Pretty much all the major markets have already had at least one location put in it. Or either smaller markets, or they're going to be adding additional locations to larger markets. Naturally, smaller market locations won't drive as much revenue as the larger ones, and putting additional locations in established markets will create at least some degree of cannibalization. Now, while the store count will double more likely than not, provided things go well, that doesn't necessarily mean that the revenue is going to double. Now, this is not taking into consideration that we will likely continue to see improvements in same-store comps over time. Speaking of comps, how are they doing? The same-store sales growth the past couple years has overall been fantastic. In the past 3 years, the NAP track, that's a third-party agency which tracks industry trends, has shown an aggregate 1.1% decrease in revenue comps. Again, that's in the past 3 years. In contrast, Dave & Buster's has seen an aggregate 18.6% increase in comps, far outpacing the overall industry. But the best of Dave & Buster's same-store sales growth may be behind them, as they actually saw a 2.7% decrease in comps in Q4 2017 compared to a 2.5% industry-wide decrease, and another 2.7% decrease in Q1 of 2018, that's the most recent quarter they reported, compared only to an industry-wide 0.3% decrease. Ouch. Those last two quarters did not look pretty good for the same-store comps, but particularly the last quarter. But hey, don't be too hard on them. At the end of the day, Dave & Buster's may just be a victim of their own success. Dave & Buster's has an impressive AUV, that's average unit volume, which is the total company sales divided by the number of locations. That's at $11.6 million. Compare that to some well-known names like Yard House at $8.1 million and Olive Garden at $4.7 million. Granted, 57% of the revenue comes from games as opposed to food and bar, but hey, I think that's not necessarily a bad thing. I mean, their concept is working. People are literally spending more money on the games than they are on the food and bar. People really like going there so they can have that added fun, that extra cool environment. People really do want something more than just food, or at least there is a demographic of people who do. They want an experience. Oh, and it doesn't hurt that the gross profit margin on the games is 89.3%. Yeah, you heard that right. I mean, hey, once these games are paid for, they're basically just sitting there raking in cash. But it's not all peaches and cream. What are the risks? At-home food delivery is rapidly growing and creating potentially challenging conditions for the overall restaurant environment. And that trend is growing much quicker than any restaurant can grow. And here's the problem. Dave & Buster's is not one of the types of restaurants likely to be receiving a lot of at-home delivery requests. People go to Dave & Buster's for the overall experience, not for the food. This is similar to restaurants at amusement parks or full-service dine-in movie theaters. Similar dining chain concepts, kind of like Chuck E. Cheese or Hooters. People don't order delivery food from Disneyland. They don't order delivery food from the movie theaters. They don't order delivery food from Chuck E. Cheese or Hooters. I mean, come on, let's be honest. People don't go to Hooters for the wings, right? You know what I'm saying? You know what I'm saying? You know why guys go to Hooters. People only want that food when it's part of the overall experience. It is true to say the exact thing which distinguishes Dave & Buster's and gives them its potential competitive advantage is also the exact thing which may do damage to the bottom line if you believe this at-home food delivery will continue to chip away in the future at people's desires to dine out. Now, I'll share with you a little bit of anecdotal feelings that I've noticed in my personal life. My girlfriend cooks dinner for us most nights, but every couple days she'll come in my office and give me that pouty little face and twirl her fingers around and say, maybe you take me out tonight. Now, a good boyfriend would say, of course, baby, but I've never claimed to be a good boyfriend. So what I ask is, do you want to go out or do you just not want to cook? Because there is a difference between those two things. Honestly, most of the time, she just wants to not cook. Her desire to go out is motivated more by not wanting to cook than it is to actually go out. In which case, if I don't want to go out or I still want to work at night, then, I'll have her go pick something up to go or go get like a rotisserie chicken at the store that's hot and ready, something like that, right? We don't necessarily need to go out. So as more and more delivery options become available, I do believe that ordering in and getting delivery will continue to see growth in the coming years. However, Again, to flip it back again, in the long run, this may work to Dave & Buster's benefit. People often don't want to go out when they can get the exact same experience at home. I mean, just look at going out to the movies, right? That used to be like a big thing. It was a popular thing. Everyone went out to the movies. Well, once you were able to get the exact same movie a few weeks later at home, online, or in the red box, for a fraction of the price, people stop going to the movies because they can get basically the exact same experience at home. Therefore, in a few years, when it becomes more commonplace to order any food you want from any restaurant you want, people may want something more from their dining out experience, or at least they may select their dining experience a bit different. After all, why would you go out to, say, Olive Garden when you can always order Olive Garden at home? Heck, just 2 weeks ago, you ordered Olive Garden at home. But when you want to go out, well, you're not going to go to Olive Garden. You're going to go to Dave & Buster's because they offer more than just a plain old dining experience. It's not just the same food that you can always get at home. You get something else when you go to Dave & Buster's, an experience which can only be fully realized by dining out. Now, yes, of course, you can get nitpicky and say, well, you can play video games and eat at home, so it's not really all that much of a different experience. And I agree to an extent, but guys, the point is 99% of the restaurants out there have nothing which truly differentiates them from all the other restaurants. You get some fun and you get some food. You don't get that at normal restaurants. And thus far, they are succeeding. Current year-over-year revenue growth is at 9.2%. This is still solid growth. However, it is slowing from their 3-year growth average, which is 15%. The stock isn't too expensive, with current earnings per share at $2.84, giving it a 20 PE. If you want exposure to a restaurant chain with the potential for outsized industry growth for years to come, I think Dave & Buster's is an eat, drink, play, buy.
That's the bottom line, because Stone Cold said so.